If you've ever searched for a business loan and ended up rejected, it's probably not because your business is bad. Most of the time, it's because you're looking in the wrong place and asking the wrong funding question. Small businesses are taught to think about funding in one way. It's either a loan or a grant. And when that doesn't work, it's easy to assume the problem's you. Based on my experience helping thousands of small businesses access billions in funding, I've seen this pattern over and over again. Funding isn't about access to cash. It's about matching the right funding to the right business problem. In this video, I want to reframe how to think about funding by introducing the idea of fit-for-purpose funding solutions. I'm going to walk you through 5 business problems that small businesses face and the types of funding that are designed specifically to solve each one. Instead of asking, can I get funding? We're going to focus on matching the business problem you're facing to the funding tool that actually fits. And if you stay with me until the end, I've got 2 bonus pieces for you. First, a simple framework to help you decide which funding is right for your business. And second, a practical checklist to give you the best possible chance of getting funded. Let's start by resetting how we think about funding altogether. I've spoken to thousands of SMMEs across South Africa, and most don't struggle because funding for their business doesn't exist. They struggle because they're trying to solve every business funding problem with the same tool. So instead of asking, can I get funding? The better question is, can I get the right funding for my business, for the problem I'm actually trying to solve? Part of the frustration comes from how traditional lenders think. Banks and traditional funders are largely backwards looking. Their mandates require them to prove your creditworthiness based on your track record, your financial history, your security or collateral. That means their funding decisions are driven by what your business has already done. So when you don't tick those boxes, the answer is often a quick no. Not necessarily because your business is bad, but because their model doesn't allow them to take that kind of risk. What's changed in recent years is the rise of alternative funding. Alternative funders think differently. Their mandates are more flexible, more innovative. They're often forward-looking, not just asking where you have been, but what are you trying to do next? The risk mitigation is built into the product itself. The funding tool is designed around a specific business need, whether that's an order, an invoice, an asset, or a timing gap. That's why these are often referred to as fit-for-purpose funding solutions. And that's where the real game changer lies. So instead of talking about funding in theory, let's look at more specific, practical tools that will make sense for your business. First, if videos like this give you value, give it a like. Let's dive straight in. The list of funding products is long. So instead of running through funding options as a random list, I want to group them by the real problems businesses are actually trying to solve. Most funding challenges tend to fall into one of 5 buckets. 1, you've got demand, but not the cash to deliver. 2, you've already done the work, but you're waiting to get paid. 3, you need assets or infrastructure to operate and grow. 4, you need breathing room to manage cash flow. And 5, newer, more alternative models that don't look like traditional funding at all. You don't need to remember all of these. As we go through them, just listen for the situations that sound like your business right now. And while I'm describing the problem, let's see if you can guess the name of the solution. Let's start with the first one. Businesses that have an opportunity on the table, but don't have the cash to make the most of them. Picture this. You've just won an order. Maybe it's a tender, maybe a big corporate contract. This is genuinely life-changing for your business. But there's a problem. You don't have the cash to buy the stock. You don't have the cash to pay suppliers or deliver. And sometimes the problem's even bigger than that. You might have bid on 4 projects, fully expecting to win 1, and then all of a sudden, you win 3. On paper, that's incredible. Well done. In reality, you're stretched. Your cash flow can't support delivering on all of them at the same time. And here's the real pressure point. If you fail to deliver, it doesn't just cost you this opportunity. It hurts your track record. Miss a delivery, delay fulfillment, or underperform, and the very thing that was meant to move your business forward can make it harder to win the next opportunity. That's where purchase order or tender funding comes in. Instead of looking at your past, your balance sheet, your collateral, your history, this type of funding is based on the order itself. But, and this is very important, it's usually tied very specifically to the delivery. You can't use it for rent. You can't use it for marketing. Therefore, it works brilliantly only when demand already exists. The problem is execution, not sales. If you've got the order, but not the cash, this fits. If you're just generally short on cash, it doesn't. This is actually a situation where funders like Sourcefin step in, funding the order, not gambling on the business. A quick shout out to them for sponsoring this video. Now, this solution works really well when you've got a confirmed order or a tender in hand. But what if your business depends on already having the stock available before the order actually comes through? Think of this scenario. You run a business where having stock on hand isn't optional. Maybe it's retail, wholesale, manufacturing, distribution. Your customers expect availability. If the product isn't there, the sale doesn't happen. The problem is cash is tied up in the stock itself. You need to buy inventory up front, long before it's sold, and the more you grow, the bigger that gap becomes. A loan here feels risky. You're borrowing based on hope, not confirmed sales. This is where inventory financing comes in. Instead of funding a specific order, this type of funding is tied directly to the stock you plan to sell. But, and this is critical, unsold stock is dead cash. If demand doesn't materialize, you're sitting with inventory and a funding obligation. Therefore, inventory financing works best when demand is predictable, turnover is consistent, and you understand your sales cycles well. If you're growing steadily and stock availability is the constraint, this fits. If demand is uncertain or speculative, it can quickly become dangerous. So far, we've been talking about businesses that have demand on the table, but don't yet have the cash to deliver. But there's another very common problem that shows up as businesses start growing. You've already done the work. You've already delivered. The product or service is with your client. The problem isn't demand. It's that you're waiting to be paid. Consider this. You've delivered the product. You've done the work. Well done. You've issued the invoice, and now you wait. 30 days, 60 days, sometimes longer. In the meantime, salaries still need to be paid. Suppliers still need to be settled. The business still needs to run. What makes this frustrating is that you know something important. That invoice that you've handed in is going to turn into money. It's not a maybe. It's not a hope. In 30 or 60 days' time, that invoice will transform into cash. The problem is your business needs the money now, not later. This is where invoice discounting comes in. Alternative funders look at that invoice and ask a different question. If the work has been done, if the invoice has been approved, and if the customer who's meant to pay is credible, then instead of making you wait, they say, let's give you most of that money today. They advance the cash up front, and when the customer pays the invoice later, the funder collects. But, and this matters, invoice discounting depends heavily on who owes you money. Funders care less about your business history and far more about the reliability of the customer that's meant to pay you. Therefore, invoice discounting works best when you're supplying trusted corporates or government entities. Payment terms are absolutely crystal clear, and the problem is timing, not performance. If cash flow is the pressure, not profitability, this fits. This is why invoice discounting is such a common alternative funding tool. It solves a timing problem, not a business problem. Up to now, we've spoken about invoice discounting, where you're borrowing against an invoice and waiting for your customer to pay. But sometimes, instead of borrowing on the back of an invoice, there's another option. You can actually sell the invoice altogether. In this case, you get the cash up front, and someone else takes over the responsibility of collecting payment from your customer. This often becomes attractive when cash flow isn't the only problem. Admin starts to pile up, collections take time, chasing payments drains energy. At that point, the value isn't just the money. It's also the relief of not having to manage the collection process yourself. This is called invoice factoring. But as with everything, there's a trade-off. You give up control of the collection process, and your customer now pays the funder directly. That can work very well in the right context, but it's important to understand where this solution fits best. One very practical consideration is regulation. In many government contracts, invoices are required to be issued and paid strictly in the name of the original supplier. That makes invoice factoring difficult and in some cases impossible to use in government environments. Because of that, invoice factoring generally works far better in corporate contracts where payment structures are way more flexible, less tightly regulated. So if simplicity and reduced admin are important, and you're dealing with a private sector customer, this can be a useful tool. If most of your work sits in government supply chains, it's often not the right fit. Up to this point, the common theme has been waiting. Waiting to get paid for work you've already done. But there's another type of problem that shows up as businesses grow. You're not waiting for money anymore. You're waiting for the tools that allow you to deliver. Here's a scenario I see all the time. You've just been awarded an unbelievable contract. The work is there, the revenue is real, but there is a catch. To deliver, you need equipment. Maybe it's machinery, maybe it's vehicles, maybe it's specialized tools or technology. And the upfront cost is significant. Paying cash would wipe out your working capital. Taking a traditional loan feels risky. You're borrowing a large amount up front, often based on your balance sheets and collateral, not the contract itself. So the problem isn't demand, and it's not capability. It's that the asset required to deliver the work is standing between you and the opportunity. This is where an alternative approach comes in. Instead of funding the business, the funding is tied directly to the asset. This is called asset financing. Rather than giving you a lump sum loan, the funder pays for the equipment, machinery, or vehicle, and you repay it over time. The asset itself acts as security. That changes everything. You don't need to drain cash reserves. You don't need to put up unrelated collateral. And the repayment is spread over the useful life of the asset, maybe even the contract. Typically, you'll repay the funding in fixed installments, either monthly or quarterly, and aligned to how that asset helps you generate revenue. But, and this is important, you're committing long-term. Therefore, the key question becomes, does this asset directly contribute to your ability to earn? If the answer is yes, asset financing can be a powerful enabler of growth. If the asset is non-essential, underutilized, or speculative, it can quickly become a burden. This is what makes asset financing different from traditional lending. The decision isn't based on your past performance. It's about whether the asset itself makes commercial sense in your business. So asset financing works well when the constraint is the asset itself, the machinery, the vehicle, or the equipment you need to deliver. But what if the real challenge isn't the asset? It's the fact that you're part of a bigger supply chain, and the pressure comes from how cash moves through that system. This often shows up when a business supplies into a bigger ecosystem. Maybe you deliver products to large corporates. Maybe you're a subcontractor on a bigger project. Maybe you sit somewhere in a supply chain where the end customer is strong. But you, as the SMME, feel all the pressure. The work is real, the demand is real, but it's that cash flow timing which is brutal. You have to pay suppliers up front. You have to pay staff to deliver. You have to keep operations moving. And then you wait. Because the bigger buyer pays on their terms, 30, 60, sometimes 90 days. So you're stuck in a squeeze. You're too small to carry the working capital burden yourself, but too busy to deliver, to stop and wait for cash to catch up. And when you go to a traditional lender, they often still look at you in isolation. How does your balance sheet look? Your collateral? What about your track record? They're not always willing to price or structure funding around the same strength of the bigger buyer and the broader supply chain. This is where a different model comes in. Instead of funding you purely based on your credit profile, the funding is structured around the strength of the larger buyer, and the payment flows inside that chain. This is called supply chain finance. In simple terms, it helps unlock cash earlier in the chain because the end buyer is credible. That can mean suppliers get paid sooner, you get working capital to keep delivering, and the larger buyer still pays on their normal terms. Everyone wins, without you having to carry the full weight. But, and this is important, supply chain finance usually works best when the buyer is large and trusted. The supply chain is structured and traceable, and transactions are consistent and verifiable. Therefore, it's not a perfect fit for one-off deals or informal arrangements. If you're supplying into a stable corporate ecosystem with predictable payment flows, this can be an extremely powerful tool. If your customers are small, inconsistent, or chain is unstructured, it's often not the right solution. So far, we've been talking about funding that's tied to something specific. It's either an asset, a supplier, or a particular part of a supply chain. But what if the problem isn't one deal or one supplier? What if the pressure is simply keeping the business moving day to day? This is a situation a lot of businesses, especially small businesses, run into. Your business is operating, you've got customers, revenues coming in, but month to month, things feel tight. Salaries are due, rent needs to be paid, suppliers want settlement, and even though the business is viable, cash never seems to sit still long enough to give you breathing room. This is one of the most common and most stressful situations an SMME can face. It's not that the business is failing, it's that cash moves in waves, while expenses are constant. So you start looking for funding, and it often gets lumped into the same category as a traditional loan. But this is where the distinction matters. A traditional loan is usually structured as a large lump sum, paid upfront with fixed repayments, regardless of what is happening in your business at that moment. Working capital funding is different. Instead of being designed for a big once-off purchase, it's meant to help smooth the day-to-day operating cycle of the business. It's typically shorter term, more flexible, and often revolving, meaning you draw down what you need, when you need it, to keep the business running. But, and this is critical, it's not designed to fix a broken business model. Because it's short term and more expensive than long-term debt, using working capital funding to cover ongoing losses can quickly become dangerous. Therefore, working capital funding works best when the business is fundamentally healthy. Revenue is real, but timing is uneven, and the goal is stability, not expansion. If you're using it to smooth out your cash gaps, it fits. If you're using it to prop up a structural problem, it doesn't. That distinction is what separates working capital as a useful tool from working capital as a trap. That's one approach, accessing funding to smooth the ups and the downs of operating cash flow. But what if the solution isn't getting paid faster? It's paying later. This solution deals with a really painful timing mismatch. You've delivered the work, you've issued an invoice, and now you're waiting to get paid. It's 30 days, it's 60 days, but your supplier, for some reason, they want to be paid cash on delivery. They want to get paid up front. So you're stuck in a timing gap. Your customer expects credit, your supplier expects cash, and you're the one carrying the pressure in the middle. This is one of the most common and most frustrating cash flow challenges an SMME faces. What often gets missed is that there's a simple fairness question buried deep inside the problem. If your business is expected to wait to get paid, is it unreasonable to ask your supplier to wait to get paid? This is where a powerful, often overlooked option comes in. This is called supplier credit, or terms from your supplier. Instead of borrowing money, you're negotiating time. You agree on extended payment terms with your supplier, whether that's 30 days, it's 60 days, or a structured payment arrangement that better matches when you get paid. And in many cases, there's no explicit funding fee attached at all. But again, and this is important, supplier credit is built on trust. Suppliers will look at your payment history, your reliability, your ability to honor commitments. That means this option might not be available on your first deal. You've got to build a relationship. As that relationship deepens and work becomes recurring, supplier credit often becomes far easier to negotiate. And it doesn't have to be an all or nothing. If full payment terms aren't possible, there are other ways to structure it. You could pay a deposit up front and the balance later, splitting payments across milestones, negotiating better pricing alongside extended terms. The key is understanding that supplier credit is flexible and negotiable. If you have a recurring work, a growing relationship, and track record of paying, supplier credit can become one of the cheapest and most effective funding tools available to your business. If trust doesn't exist yet, or the supplier relationship is one-off, it's much harder to rely on. That approach works for many businesses. But what if your business doesn't operate on invoices at all? What if it runs on daily sales and card transactions? Suppose you run a business where money comes in every day, or at least most days. Maybe you're a restaurant, maybe you're a salon, maybe a retail store, or even an online shop. You're a business that takes card payments and has steady transaction volume. The business isn't struggling because there are no sales. The problem is that cash moves in cycles. Some months are strong, some weeks are quiet. Sometimes you need to buy stock up front, pay staff, cover rent, and only then the revenue catches up. So you're not necessarily looking for a long-term loan. You're looking for a fast working cash to handle the operating cycle. And you want repayments that don't crush you when sales dip. This is where a different type of funding comes in. Instead of looking at your collateral and your history, the funder looks at your sales flow, especially card sales, and says, if your business regularly makes sales, we can advance you money now, and you repay it gradually as sales come in. This is called merchant cash advance. And here's the simplest way to understand it. You get a lump sum up front, and instead of paying fixed installments every month, you repay a small percentage of your daily or weekly sales. So when sales are strong, repayments can happen faster. When sales dip, repayment slows down. That flexibility is the main attraction. But, and this is the important part, the trade-off is usually the cost. Merchant cash advances are typically more expensive than traditional lending because they're designed for speed and accessibility, and the funder takes on more risk. So this is not the kind of funding you use just because it's available. Therefore, merchant cash advance works best when you have a strong, consistent sales volume, you have healthy margins, and you're using the funding for something that increases revenue or protects the business, like stock, a short-term opportunity, or a temporary cash gap. It does not work when your margins are thin, your sales are unpredictable, or you're using it to pluck a long-term structural gap. Because if the business is already tight, taking a higher cost product can make the pressure worse. So for the right type of business, with steady card sales and good margins, this can be a powerful short-term tool. For everyone else, it's one to approach carefully and only when the situation truly fits. Merchant cash advance is one way to access funding based on how your business transacts. But in some environments, the funding doesn't sit outside the system at all. You've done the work, you've issued the invoice, and instead of 30 or 60 days, the question becomes, what if I could get paid right now, at the exact moment I submit the invoice? For many SMMEs, the real problem isn't access to funding in theory. It's access to funding at the precise moment the cash gap appears. You don't need a big facility. You don't want a long application process. You just want to close the timing gap immediately and move on. This is where one of the more sophisticated funding models comes into play. In certain platforms or systems, often accounting software, procurement platforms, or supply chain tools, funding is built directly into the workflow. You upload an invoice, the system recognizes it, and you're given the option to get paid immediately, usually at a slightly reduced amount. This option is called embedded lending. The key idea here is convenience and timing. Instead of applying for funding separately, the funding is available at the point of need, inside the system you're already using. But, and again, this is important, this type of funding is not widespread. It's still relatively rare. It tends to exist in more sophisticated or technical environments, and not every business platform or industry has access to it yet. There's also a very clear trade-off. Because you're getting paid immediately, you're usually accepting a discounted invoice value or a higher effective cost for the speed and the convenience. So, embedded lending works best when speed matters more than cost. The timing gap is the real problem, and the business values simplicity and immediacy. It doesn't work well when margins are tight, the cost outweighs the benefit, or the platform you're using doesn't support it. When it exists, embedded lending can be a genuine game changer, turning invoice into cash almost instantaneously. But because it's still scarce and situational, it's best seen as a powerful tool in the right context, not the universal solution. We've covered a lot of ground. We've covered different business problems. We've covered different funding tools. And we've also looked at some of the trade-offs for each of those tools. Now, the obvious question is, how do you actually decide which type of funding is right for your business? Rather than guessing or defaulting to a loan or a grant, I want to give you a simple decision framework. 4 questions. That's it. You don't need to memorize products. You just need to answer these 4 questions honestly. Let's take them one by one. Question 1. What problem am I solving? This is the most important question, and the one most people skip. Not what funding can I actually get, but what problem am I actually trying to solve in my business? Is the problem that you've won work but can't deliver yet? That you've delivered work but haven't been paid? That you need equipment to operate? Or that the cash flow is uneven month to month? Why this matters is simple. Different problems require different tools. Trying to solve a delivery problem with a generic loan often creates more pressure, not less. Let's move on to question 2. Is this a timing problem or a risk problem? Once you know the problem, the next layer is understanding its nature. Some funding problems are about timing. The others are about risk. A timing problem looks like the money is coming, just not now. A risk problem looks like I need to take on something new before the money even exists. Why this matters is because alternative funders price and structure funding very differently depending on this distinction. Timing problems tend to attract tools like invoice discounting, supplier credit, or embedded lending. Risk problems tend to attract tools like purchase order funding, asset finance. If we get this wrong, the funding will feel expensive or restrictive. Let's move on to question 3. What am I prepared to give up? The trade-off. Every funding option has a cost, but that cost isn't always just interest. Sometimes the cost is margin, flexibility, speed, control. Maybe it's admin. The key question isn't what's the cheapest funding? It's which trade-off can my business comfortably live with? Fast funding often costs more. Flexible funding often has limits. Cheap funding often comes with conditions. There's no right or wrong, only what fits your situation. Question 4, is this once-off or is it recurring? Finally, ask yourself, is this a once-off situation or is this something my business will face again and again? Why this matters is simple. Once-off problems can be solved with a once-off funding tool. Recurring problems need structural solutions, not repeated funding. If you keep using short-term funding to fix a long-term issue, funding becomes the problem. I'd love us to put this together using 2 practical examples. Let's make this real. Example 1, let's think of purchase order or tender funding. You've just won a big order. If we ask question 1, what problem are you trying to solve? You need to deliver confirmed work. Is it timing or is it risk? I need funding before revenue exists. Question 3, what am I prepared to give up? Well, you want to give up flexibility. The funding must be used only to deliver the order. And the final question, is it a once-off or recurring? Well, it's only a project, so once-off makes sense. That combination naturally points towards purchase order or tender funding. And again, this is exactly the kind of scenario where specialists like Sourcefin operate, funding the order itself rather than relying on your past track record. Let's think through a second example. Remember invoice discounting? That's a different situation. Remember, you've already delivered the work. You've issued an invoice, but now you're waiting to be paid 30 or 60 days. Question 1 is, what problem are you trying to solve? It's cash flow. Question 2, timing or risk? This is pure timing. The money is coming, just not now. Question 3 is, what trade-off are you prepared to make? A small portion of the invoice value in exchange for getting paid earlier. And then question 4, once-off or recurring? This could be either. Recurring if this happens every month. That combination points naturally towards invoice discounting. Again, this is a space where alternative funders like Sourcefin specialize, turning approved invoice into instant cash instead of forcing you to wait. This is where the Sourcefin application link will come in handy in the description below. Once you've answered these 4 questions honestly, the right type of funding usually becomes clear. But the next step is actually making sure you're ready to access it. So let's talk about how to give yourself the best possible chance of getting funded without overcomplicating things. We've put together a fundability toolkit. These are 5 things that's going to make it easier for your business to get funded. So once you've worked through the decision framework and you know what type of funding fits your business, the next step is this. How do you give yourself the best possible chance of actually getting funded? This is where a lot of SMMEs fall over. Not because the funding doesn't exist, but because they're not prepared for how funders think. So here's a simple fundability toolkit. 5 things that dramatically improve your chances, especially when working with alternative funders. Let's go through them one by one. Tool number 1, know your numbers. Just make sure they're the right ones. You don't need a 40-page business plan anymore. What funders care about is whether a specific deal makes sense. Let's use purchase order funding as an example. The numbers that really matter are the value of the purchase order, the value of the supply quote. Let's calculate that margin. The gross profit on the deal, that's the one that really matters. How long delivery will take, the supplier's lead time. In other words, does the deal work commercially? Is there enough margin? Is the timing realistic? What about the risk of the deal? Clarity here builds confidence. You don't need perfect numbers, you need understandable numbers. Tool number 2, separate your personal and your business behavior. This one is critical. Funders need to see a clear line between you as an individual and the business as an operating entity. What does this mean? Clean bank statements, clear transaction flows, consistent behavior. When personal and business finances are mixed, it creates uncertainty, and uncertainty slows everything down. Separation doesn't mean perfection, it means intentional structure. Tool number 3, match the story to the funding product. Here's a simple but powerful idea. Funders aren't funding you. They're funding a specific risk, deal, or scenario. So your story needs to match the funding you're applying for. If it's purchase order funding, let's talk about delivery, talk about the suppliers, talk about your end buyer, talk about the execution. If it's invoice discounting, talk about your customer, talk about payment terms, or talk about the timing. When the story matches the product, funding conversations become so much easier. Tool number 4, lead with your character, not your creditworthiness. This is where alternative funders really differs from traditional lending. Traditional funders are heavily focused on your creditworthiness, past performance, collateral, history. Alternative funders care deeply about your character. The real question they're asking is, can we trust you? In something like purchase order funding, if a deal goes wrong, the funder can't always recover immediately. They may need to work with you, restructure, agree on a payment plan. That means trust is foundational. In many cases, alternative funders are more like partners than lenders. Their interests are aligned with yours. If the deal works, everyone gets paid. That's why honesty matters more than looking perfect. If something isn't ideal, explain it. A clear, honest story builds far more confidence than something that looks polished, but doesn't hold up under the questions. This is often where long-term relationships with funders like Sourcefin are built, when trust is established early and consistently. Tool number 5, be ready before you are desperate. Timing is everything. One of the most common mistakes SMMEs make is waiting until the last possible moment. They open up Google and they type funding or loan. They apply to the wrong places. They get rejected. They get demotivated. And then they approach the right funder with only a few days to spare, putting pressure on everyone involved. The real power is knowing what funding do you need before you urgently need it. That's why this entire framework matters. And just because we really want to enable you, we thought we'd throw in a bonus. Build a funding folder once and use it everywhere. Here's a practical tip that saves time and stress. Create a single folder. It can be digital or physical, with the documents funders almost always need. Typically that includes ID documents for directors or members, your company registration documents, your 3 months most recent bank statements, maybe a proof of bank account, a tax compliance certificate, and then, depending on the funding, the purchase order, supplier quote, or invoices. Funders can only move as fast as the information you give them. If everything is ready and easy to access, the process becomes faster for them and far less painful for you. When you combine the right funding decision with solid preparation and an honest, trust-based approach, funding stops feeling intimidating. It actually becomes a tool, one that can enable your business to grow. We've covered a lot in this video. We've unpacked the different types of funding that actually exist, far beyond just loans and grants. We've looked at how to decide which funding is the best fit for your business based on the real problem you're trying to solve. And we've walked through a practical fundability toolkit to help give yourself the best possible chance of getting funded. The big idea I want you to walk away with is this: funding doesn't have to feel confusing or intimidating. When you understand what type of funding you need, you're no longer searching blindly. You're empowered. You know what to look for. You know what to ask for. And you know which service providers are actually relevant to your situation. That alone dramatically improves your chances. And once you've matched the right funding to the right problem and prepared properly, funding becomes what it should be, a tool that enables growth, not a source of stress. If you found value in this video and you want more practical, real-world breakdowns like this, I'd so appreciate it if you subscribe to the channel. And if you'd like to see what this looks like in practice, how the right funding has genuinely helped SMMEs grow, survive, even scale, check out our SMME Stories playlist. I'll link it here, and you can explore real conversations with business owners who've lived this journey. Thanks for spending the time if you made it this far. Our aim on the Great Enabler podcast is to equip you with the knowledge and skills to take your business to the next level, quicker and easier. I hope this gives you clarity, confidence, and momentum as you navigate your own funding journey and ultimately move your business to that next level. Wishing you all the best, and I can't wait to see you on the next video.